The hypothetical announcement of a Bitcoin order by a U.S. president, particularly one with the disruptive policy pedigree of Donald Trump, would represent far more than a mere shift in domestic financial regulation. It would constitute a seismic geopolitical event, a direct assault on the foundational principles of the international monetary system that has prevailed since the Bretton Woods Agreement. Such an order, whether mandating the U.S. Treasury to hold Bitcoin as a reserve asset, granting it legal tender status alongside the dollar, or providing sweeping regulatory exemptions to foster a domestic crypto industry, would be interpreted in Beijing not as a financial innovation, but as a deliberate and calculated escalation in a long-simmering technological and strategic conflict. China's response, therefore, would not be a simple reflexive ban or a statement of condemnation. It would be a multifaceted, meticulously calibrated, and ruthless strategy executed with the singular objective of preserving its monetary sovereignty, derailing the perceived threat to its digital economic ambitions, and asserting its own vision for the future of global finance. This would mark the true opening salvo in a new digital currency war, fought not with bullets, but with bytes, algorithms, and strategic economic statecraft. The first and most immediate layer of China's response would be rooted in a doctrine of absolute monetary defense. The Chinese Communist Party's fundamental, non-negotiable imperative is the maintenance of total control over the levers of its economy, and the capital account is arguably the most critical of these levers. A U.S. embrace of Bitcoin, a decentralized, borderless, and peer-to-peer financial network, would be perceived as an existential threat to China's capital controls, the very mechanism that has allowed the People's Bank of China to manage the yuan's exchange rate, insulate the domestic financial system from volatile cross-border capital flows, and prevent the kind of capital flight that could destabilize the economy. The prospect of Chinese citizens and corporations being able to move vast sums of wealth overseas instantly and beyond the purview of the State Administration of Foreign Exchange via Bitcoin would be a nightmare scenario for Beijing's economic planners. Consequently, the domestic crackdown on cryptocurrencies, which has already been progressively intensified since 2017, would be elevated to a level of unprecedented severity. All remaining loopholes and gray markets for crypto trading, mining, and peer-to-peer transactions would be systematically eradicated through a combination of sophisticated digital surveillance, draconian legal penalties for noncompliance, and a pervasive propaganda campaign framing cryptocurrency, not just as a speculative risk, but as an unpatriotic act that undermines national financial security and plays into an American strategy of economic sabotage. Simultaneously, China would accelerate the deployment and internationalization of its primary strategic counterweapon, the digital currency electronic payment system, the Digital Yuan. A U.S. Bitcoin order would provide the perfect geopolitical justification and the urgent impetus to fast-track the DCP's global rollout. The narrative would be clear and compelling, especially to developing nations wary of American financial dominance. China would position the Digital Yuan as the antithesis to Bitcoin's volatile, speculative, and anarchic nature. It would be marketed as a stable, state-backed, and efficient alternative for the digital age. Unlike Bitcoin, which operates outside state control, the Digital Yuan offers the Chinese state perfect traceability, programmability, and oversight over every transaction. The strategic push would involve aggressively integrating the Digital Yuan into its Belt and Road Initiative infrastructure projects, offering it as a settlement currency for trade with partner nations in Asia, Africa, and Latin America, and creating bilateral digital currency swap lines to bypass the dollar-centric banking system known as the CHIPS system, and to a lesser extent, the European SEPA network. The objective would be to build a parallel digital financial ecosystem where the US dollar, and by extension a US-embraced Bitcoin, holds diminished influence. This would be a direct challenge to the petrodollar system and the global dominance of dollar-denominated financial messaging through SWIFT, not by replacing it with another decentralized asset, but by replacing it with a more advanced, state-controlled digital competitor. On the diplomatic front, China would leverage its considerable influence within multinational institutions to build a coalition of nations resistant to the American digital financial pivot. It would work tirelessly within forums like the G20, the International Monetary Fund, and the Bank for International Settlements to frame the U.S. move as a reckless act that introduces systemic risk into the global financial architecture. Chinese diplomats would argue that the volatility of Bitcoin makes it an unsuitable foundation for global reserve systems, and that the U.S., in its pursuit of technological advantage, is abdicating its responsibility as the steward of the world's primary reserve currency. Beijing would seek to rally other major economies, particularly those with strong capital controls, or skepticism of U.S. financial power such as Russia, India, and potentially even some European nations, to adopt a unified regulatory stance against private digital assets, and to champion the development of their own central bank digital currencies built on similar principles of state sovereignty and control. This would create a fragmented global digital landscape with a U.S. motto, a lead bloc centered on private decentralized cryptocurrencies, and a Sino-Russian bloc centered on state-controlled digital currencies, forcing other nations to choose a side or navigate a complex and costly middle path. Furthermore, the technological dimension of this conflict cannot be overstated. China would likely double down on its investments in the foundational technologies that underpin both Bitcoin and its own digital infrastructure. This includes a concerted effort to achieve dominance in areas like blockchain scalability, quantum computing resistance for its cryptographic systems, and the creation of its own state-sanctioned, permissioned blockchain networks for enterprise and government use. The goal would be to ensure that even if the US gains a first-mover advantage in the cryptocurrency space, China maintains technological parity or superiority in the underlying architecture of the next-generation internet and financial systems. We would likely see a Great Firewall equivalent for finance, a sophisticated technological barrier designed to detect, block, and neutralize any attempt to transact with foreign-based cryptocurrency networks from within China's digital borders. This would be complemented by a push to set global technical standards for central bank digital currencies, ensuring that the Digital Yuan as architecture becomes the de facto model for a significant portion of the world, thereby locking in Chinese technological and strategic influence for decades to come. In conclusion, the notion of a currency war beginning with a US Bitcoin order is not hyperbole. It is a precise description of the inevitable chain of events that would unfold. China's response would be a masterclass in comprehensive state-level strategy, blending domestic repression with international offensive maneuvers. It would leverage its technological prowess, its diplomatic weight, and its state capitalist economic model to counter what it perceives as a direct challenge to its core national interests. The conflict would not be over which nation has the stronger army, but over which vision for the future of money will prevail. A decentralized, open and potentially volatile system championed by the United States, or a centralized, state-controlled, and stability-oriented system engineered by China. The battlefield is the global financial network. The weapons are digital currencies, and the ultimate prize is nothing less than structural power in the 21st century global economy.